Hey guys, I hope you and the families are doing well. Welcome back to another video in the series Lessons from a Tape Reader. In this video, I'm going to take you through my current Uber trade. Now I'm long at the time of filming this, and there's 7 key learning points. So by the end of this video, I'd love you to know a lot more about these 7 key areas, which is going to be visual signs of institution, accumulation, and absorption, how to use multiple time frame analysis, where to target entries, how to control risk, selling guidelines to optimize profits, pyramiding into positions and backstopping a profit on the pyramid, on the add to the position, and then trading the right type of stocks too. So on trading the right type of stocks, you'll see the MarketSmith chart of Uber loaded up. They're today's video sponsor. If you're interested in a discounted trial, then there is a link in the comment section below, and you'll see that I'm highlighting the earnings and the estimates and the stock going into all-time high territory. That is about trading the right type of institutional stocks. So the purpose of this video is to help you with your tape reading, which means that when you look at a chart, you're trying to follow the footprints of large operators. What are they doing? Are they accumulating? Are they absorbing supply? Are they distributing the positions? Where do you see that in the context of the chart? Does it happen around a key moving average? Does it happen when the stock is, say, extended from the 10-day EMA? Where are you seeing it, and what is happening is going to be really, really important. So we're going to work through visual signs of institution, accumulation, and absorption, and that's going to tie in nicely with point number 2, how to use multiple time frame analysis. So we've got the daily chart on the left, and then we've got the 1 hour chart on the right hand side here. As we're then talking about this and we're talking about these entries, I'm going to speak about where to target the entries. This is how I target entries, how to control risk, selling guidelines to optimize profits. Then I'm going to talk about a little bit in terms of pyramiding into positions. This is really effective if a cup and handle develops and I get the initial entry at the bottom of a cup as it's then transitioning up and out the right hand side, then into the handle where I can be looking to add. So we'll talk about that, and the pyramiding, backstopping in profits, and then trading the right type of stocks. Already covered that. That's the TML type stocks. So big earnings, big estimates, preferably all-time high territory, global products, institutional liquidity. They're the kind of things that I'm looking for. So let's just start off with a high-level overview for Uber here. Now it turns out to be a continuation base, and it's a cup and handle. So there's the cup, there's the handle. So the initial entry is on that transition out the bottom of the cup, and then it comes up the right side, builds this handle, puts in a shakeout demand tail, which is covered in the blueprint video. I take you through the type of setups I target, entry candlestick, trigger bars, shakeout demand tails, gap down reverse bars. I recommend you watch that if you haven't. And then there's the add point here where I can then bump up the stop loss, backstop in a profit, and then what I'm trying to do is ride combinations, 10-day EMAs, 21-day EMAs, potentially keep some back for the 50-day as well. So very high level. This is a cup and handle type pattern with two points where I'm looking to enter position. So just to explain that a little bit more, when I'm looking at a stock, I'm imagining, okay, how may this play out? Okay, what type of chart pattern am I expecting to see? Now that happens a lot in terms of the context of the stocks. As I said, Uber is a true market leader type stock. It's one of those O'Neill can slim type stocks. Big earnings, big sales, big growth, potentially ahead of their estimates into all-time high territory. Institutions in there proactively accumulating. And it's really about trying to follow their footprints. But specifically on a cup and handle, there's 2 points in a cup and handle where I'm looking for positions. That's going to be right here on the transition up and out the cup, and then it starts running out the right hand side. Why? Because I'm playing everything forward in my mind, and I'm thinking about the optimizing profits, both in terms of monetary gain, but also efficiency of the gain. So the points where I'm then looking to enter on a chart, and obviously you only know it in hindsight, but where I'm looking to then target positions, because I think it's going to be a good point to be optimizing profits and not just tying my capital up for weeks and months and years and the stock's not gone anywhere. When I'm entering a position, I'm expecting certain things to happen. Basically, what it is you see here, there's my stutter, what it is that happened on Uber. Okay, I'm expecting these quick moves up. That's where it should happen. That's kind of the story that I've got on my head. Same in the handle as well. Okay, when I'm looking to enter here, okay, my expectation is Uber should basically just power out of this handle here, whatever cup and handle it should be. If my time is on, I'm expecting the stock to just go. I'm then expecting a testing action. So this is then a mental framework. I appreciate there's a lot of information coming at you, but with every entry that I take, I have a framework. I'm expecting 3 things to happen after it, okay? What I'm expecting, if I show you the handle part, what I'm expecting is a pop, a test, and then a reversal, which is basically higher high, higher low, higher high. Okay, this is what I'm expecting. So if you look at the first one here, pop, test, reversal. Same here, pop, test, reversal. Now that builds into the framework because there's 4 parts of every single trade. We have identify, we have control, we have mitigate, and we have optimize. So that risk mitigation, I'm looking to do that within the context of the pop. So after my entry, I'm expecting a pop. Can I free roll into that? pop, can I free roll into that, get all of the risk out of the trade? Now, when I'm targeting a lower pivot, okay, within a developing base like this, my expectation is, well, the stock is then likely to stall into overhead resistance. So if you look here, the reason why you often get handles within a cup and handle, if I pull this pink area across, is because you have trap buyers. So there is going to be overhead resistance. Now, oftentimes it's more so psychological resistance. It's not actually that trap buyers here who are buying here, they've held it down here, okay, they get back to break even, they want to remove the pain because they've just been holding this stock down 5%, 10%, 15%, 20%, whatever it may be in terms of depth of the cup, but they want to get rid of that loss in their portfolio. So they're like, down here, oh, I've got this loss, as soon as this gets back to break even, I'm going to sell. So they start selling in here. But then you have well-trained traders who can identify these lower pivots within bases and these lower entry points, and guess what? They understand that, well, there's probably going to be psychological resistance and overhead resistance at the top of the base. I'm going to sell part of my position into it too. So then it becomes a self-fulfilling prophecy quite quickly. So when you then start to see the stock stall out as it gets back to base highs like this, it's all very logical. But this is where the tape reading comes in. We're trying to assess, okay, is this normal behavior? Would we expect that? Now, how do we understand that concept? Well, it's linking, okay, what are we seeing from a supply and demand perspective when we look at the candlesticks, when we look at the volume, when we look at the relative strength, when we look at, is the stock holding above certain moving averages we would be expecting it to hold above? So here and here, just to kind of summarize, in terms of a developing cup and handle, in here, in the cup and then in the handle as well, that's where I'm going to be looking for setups. Now, the location of things is really, really important. Okay, so when you get these bigger TML type stock, Uber, you can't see it, but over on the left hand side here, Uber built a very big phase one type base. So this is the first kind of trend of that base, gets included in the S&P 500, kind of good catalyst during this time as well, and then it pulls back down. So this is going to be really the first testing around the 50-day SMA. Now, does it have to come back to the 50-day, the purple line every single time, bounce perfectly off of it? Absolutely not. But as it's pulling down to the 50, this is where the tape reading comes in. Okay, this is where I'm looking for the footprints. Okay, Uber, I'm now looking for the footprints, and I love using the 1 hour time frame. So my two main time frames that I look at is going to be the daily chart and also the 1 hour chart. I'm aware of the weekly chart, I'm aware of monthly charts, but where I spend the vast majority of my time is the daily chart and also on the 1 hour chart as well. So what I'd like to do is take you down here within this blue area. So this is going to be the bottom of what turns out to be a cup. Now remember, I have an imagination here. I'm going, okay, Uber's pulling down to the 50. As it pulls down here, I'm looking for signs that, okay, demand is starting to overpower supply. The bigger boys and girls go, great. We see the two things we require above everything else. We see liquidity and we see perceived value. It's always perceived value, because what you value, institutions may not value. What institutions, when they see enough value, you may not see that as enough value. Okay, so this is understanding the different market operators within the market, and a little bit later on I'm going to try and remember to talk about this bar here, which is a supply shoot, and explain do not buy that because it's very V-shaped in nature. Okay, it's going to pull back in here, and the shakeout demand tail is a much better place, I think, to be looking to enter. So this blue area here, okay, we're going to go take a look at that, and we're going to look at it on the 1 hour chart. So I'm just going to pull all of this across here, but so we can still see it. So something like that, okay? So this is the daily chart here, and now what we're doing is we're looking at the blue area and we're looking at the 1 hour chart. So this is really the crux of this video. If you get nothing out of it, I'd like you to get this out of it. So this is about understanding institutional footprints. So when institutions are in the market, guess what? They can only buy and sell. Okay, same as you. They can only buy and sell. They can do it in much greater quantities, most likely. Okay, the Fidelities, the JP Morgans, sovereign wealth funds of the world, whatever it may be, but they can only buy and sell. And because of their size, our expectation is we should be able to see their size on the chart. When they start stepping up and they start supporting the stock and they go, right, we're moving back in here, okay, we should be able to see it, because remember, it's institutions that create lows in the bases. Okay, it's the Fidelities, it's the JP Morgans, it's the Goldman Sachs, it's the sovereign wealth funds, it's the pension funds, the mutual funds. They are the guys and girls creating the lows in the base. So this is what I'm looking for in areas where I'm expecting large operators to step up and support true market leaders. I'm not talking about a $50 million biotech company with just a tiny market cap. I'm talking about Ubers, I'm talking about Nvidias, I'm talking about CrowdStrikes, Palo Altos of the world, whatever the leading stocks of the day may be. I'm talking about those stocks. Now, my expectation is large operators should step up and support those leading stocks that are displaying a lot of relative strength around certain moving averages. The two ones that I'm going to be looking at most closely closely is going to be the blue line, which is the 21-day EMA, and also the purple line being the 50-day SMA. Now, does it always have to hold to the penny? No, it doesn't. It's regions, it's areas where I'm looking for what I'm about to show you. So two really key bars are going to be this bar here and also this bar that you see over here. So the first one is a gap down reversal bar, okay? So the prior closes here at about $58.38. The prior closes here. What happens? Price gaps down, opens here at about $57.43 and then pushes up. And look at the volume coming through. This is now acting as a change of character. Okay, this is the first sign that really large operators are in there and they're starting to step back up and support the stock. Remember, value and perceived value and liquidity, two things they require above everything else. Now, where you then get more so the change of character coming through is this bar here, okay? So the prior close here about 57.55, it gaps up, opens here, pushes up. So what we have here, these two bars that I'm pointing to, this bar here, so this bar here and this bar here, this is what institution accumulation looks like. Leading stock pulling back down towards the 50. I'm on the lookout for this. Gap down reversal bars, shakeout demand tails, and then also what I call bullish synchronicity. Price gaps up, volume increases, gaps there, opens there, pushes high, strong close, and it's a widespread candlestick, bullish synchronicity. So the large relative volume is confirming the positive price action that we see. So that for me is the visual footprint of, okay, that's what accumulation looks like. But then we need to go into what does absorption of supply look like? And this for me is making that causal link to what Livermore called the line of least resistance and the pivotal point has formed. So the line of least resistance, when I start to see this happening like this, and it's holding in a region on the daily chart where I'd expect it to, and you're also seeing a lot of other TML type stocks setting up similar to this as well. So the Nvidias of the world, the Broadcoms of the world, the CrowdStrikes of the world, those kind of stocks as well. Okay, this is then the pivotal point forming. So oftentimes before a stock will then break to the upside, you'll see a contraction in price volatility, right? This is the Toby Crabell point with narrow range 4s, narrow range 7, 2-bar NR, 3-bar NR, Minervini, VCP, volatility, contraction, all of that stuff, right? So what you have here is you have signs of institutions stepping back up. I'll take you through the dollar volume of those two bars in a second, but you see the tightness coming through in here. So this is an important principle to learn and just ingrain, is from areas of contraction come expansion, and that's either going to be expansion to the upside or expansion to the downside. But because I'm starting to see these footprints here, and then I start to see the tightness on the 1 hour chart, my expectation is the expansion should be to the upside. Like these bars that follow, more bullish synchronicity bars, widespread candlesticks, volume confirming the positive price action, these should happen. And then I should be able to free roll into that. So this is how you start to build out your process and your framework to go, okay, there's 4 parts of every single trade, whether you want to do them or not. Number one is you have to identify setup. Now, how I identify setup when I'm teaching you here may be very different to what you do, or Joe Blogs do, or John down the pub, or whatever. How do you go about controlling the risk to create asymmetric risk-reward trades? We'll come on to that in a couple of minutes time. How do you then mitigate the risk? Do you want to mitigate the risk? I personally love risk mitigation. I think psychologically it really helps me as well to get in, hit it hard, remove all of the risk from the trade, and then just let the stock trend. So psychologically it's very useful for me as well in terms of financially too. And then also the optimizing profits. What are the selling rules? What are the selling guidelines that you are using to then ride trends and then exit when trends start to end? It's all very, very important how you kind of structure this and how you build this as well. So I just want to take you through this here. Tightness in price after you see these positive change of character bars and volume generally drying up. So to my mind, this is what absorption of supply looks like. Tightness in price. Do you see how tight this is acting? And it's in the context of right after that bar, and it's a leading stock pulling back down to the 50. And if I just take you through the dollar volume on those two bars, let's bring up our calculator. So if we just go through the dollar volume, this first bar here, okay, the volume on this bar here is going to be about 4 million, and on the second one here, it's, if we just take an average, both of them about 4 million. So it's going to be around about 8 million shares are traded on those first two 1 hour candlesticks. If we took an average price, if we say the average price is 58 and 58, let's just do 58, okay, just to illustrate the point. So we times that by 58. So on these first two 1 hour candlesticks, if I move this over here, on this candlestick here and on this candlestick here, which are the first two 1 hour, the first candlesticks on those sessions, so we have two 1 hour candlesticks, obviously that's when bigger boys and girls are going to be most active, the first 1 hour of the session. Okay, like you have your trading plan, they have their trading plans. So the dollar volume on those two bars roughly is $464 million worth of stock traded. Okay, on those two bars. What does it look like bigger boys and girls are doing? When you then link these bars back to actually dollar volume, you're like, wow, there's $464 million circa traded on those two candlesticks. What does it look like they're doing? Like, what does it look like they're doing? So this is a gap down reverse bar, gap down, open here, push up. It doesn't look like distribution. That's a classic tactic large operators use. Okay, gap it down, open it there, scare out the weak hands, step in, absorb the supply. Then this one here as well. Okay, accumulation. This is what it visually looks like. So for me, when I'm then planning a trade out, I'm looking for bars like this, okay, and then looking for optimal 1 hour daily candlesticks as well, and then optimal action on the lower time frames as well. Because for me, I want to target through the high there and place my stop just underneath the low, because my expectation is price should move through that level. If it comes down here and undercuts these bars, and certainly these bars, like, my time is off. My reason for being in the trade is gone. I think I'm seeing large operators starting to step up and put that proverbial line in the sand. So if it starts coming underneath that line, I'm out. I'll reset, I'll recalibrate, I'll go again another session. It's absolutely fine. Then in terms of the controlling risk, you'll see the initial stop loss is 2.28%, including slippage and things like that. Now what I'm doing is I'm using it relative to the stock's 20-day average daily range percentage. It's just a nice risk metric, okay? So I'm trying to keep the risk in check. So my average stop loss is usually somewhere between 2% and 4%. If I start going greater than 4% and get around 5%, I've got to think it's a very, very good setup indeed. And ideally, I'd like the 20-day average daily range percentage to be greater than 5%. If I have a 5% stop, I'd like it to be greater than 5%, ideally like 7%, 8%, 9%, 10%, to be honest with you. But what I'm doing here is I'm trying to keep the risk in check, okay? So if I'm targeting trigger bars, which are tight, low volume inside bars, there's not really a great one on this chart here. Maybe like this is a trigger bar here, okay? If I'm targeting one of those, ideally I'd like it to be sitting on at least one or more key moving averages, being the 10-day EMA at a minimum, that you can see the shakeout demand tail. But ideally I'd like the initial stop loss to be half to 2/3 versus the 20-day ADR percentage. It's just a nice way to be keeping the risk in check. If I'm targeting, say, shakeout demand tails and trigger bars, shakeout demand tails and gap down reversal bars off the daily chart, then I'm looking for it to be around the 20-day ADR percentage. Sometimes it can be 1.5 times the 20-day ADR percentage, but as I said, if I start getting 4%, 5% territory, I got to think it's a really, really good setup indeed. But my expectation is price should just move quickly through here, stop loss underneath the low invariably. That's then tying in with one or more key moving averages. So stop in this instance here is below the 10 and the 20, and my expectation is it pops back through, stalls into the base high, and then pulls down over here. But these are the signs, these are the things that I'm really, really looking for. So that kind of covers a fair bit of it in terms of visual signs of institutional accumulation and supply, how to use multiple time frame analysis. These are the kind of things that I'm looking for, specifically these bars here, but in the correct context on the daily chart. So off 10-day EMAs, off 21-day EMAs, off 50-day simple period moving averages, where to target the entries. So understanding the type of base, a type of continuation type pattern that you are targeting. So if we just pull this back over here, okay, like this. So understanding the type of basis. So for me, I'm looking for the strongest stocks in the market. You can see all the 52-week highs, powerful RS line for Uber, nice liquid stock, good fundamentals, all of that stuff. I'm looking for the cup and handles, the flags, the VCPs, the Darvis boxes, the pennants, the wedges, all of that good stuff, right? And then it's where are you expecting certain things to happen? So you're then expecting certain things to happen off certain moving averages. So for me, the three most important moving averages that I use for these leading stocks, 10-day, 21-day, and 50-day. And then I'm looking for certain things to happen around that. I'm looking for signs that institutions are stepping up and supporting it. So that could be in the form of shakeout demand tails. It could be in the form of what I was just taking you through on the 1 hour chart. Controlling risk, we covered that. Let's cover a little bit of the selling guidelines to optimize profits, and then also pyramiding into positions. The pyramiding one will be pretty cool actually. So let's go and do the pyramiding one, and then we'll do the selling guidelines. So if I'm targeting what I think could turn out to be a cup and handle, okay, so I'm targeting it much lower in the base, which is where I'd rather be with these larger mega cap type stocks, getting much lower in the base. What I don't want to be, and I told you I was going to talk about this bar here, this is a supply shoot. Okay, let's maybe move this here. This is a supply shoot. So where do you see the supply shoot? What is actually going on this bar? Again, we can go into the tape reading here, kind of purpose of this video, right? So you see this bar here, it's a supply shoot. What does that mean? Well, if you take a look here, price is trying to break out of the base. It's trying to break out, right? So what is this bar telling us? Some people will also call it a shooting star. Price is trying to go up, and then sellers are bringing it back down. Okay, price is trying to go up in the session. We can see that because of the shoot, right? I don't know why it's called, some people call it other things. For me, it's a shoot, right? It's a green shoot, like it's trying to go up, right? You ever see a plant like growing when you were at school? Okay, it's like that. So it's a supply shoot because there's supply. So willing buyers are stepping up. They must be because price is going up, but then selling was able to overpower it. So supply on this bar was greater than demand, but it's kind of logical, right? You have a bunch of breakout traders that are then trying to buy this as it's breaking out above this base here. But look, it's V-shaped in nature. I don't buy V-shaped breakouts. Never, okay? I'm not buying that V-shaped breakout. I'm going to wait for a pullback. So then look, then you get this shakeout demand tail. So you think about this. So again, a lot of trading is having situational awareness of where are you expecting certain large operators and other market participants to do certain things. So if you look at this here, right, this supply shoot, well, that kind of makes sense to us. And look at the volume, okay? The volume is pretty feeble, but institutions aren't buying that breakout. That's retail traders who've been taught to buy base breakouts, even if it's V-shaped in nature. Okay, that's retail traders, okay, breakout traders buying that. And then where would they place their stop losses? I don't know, maybe just underneath the lows here. So then look, then there's a shakeout demand tail 2 bars later, whoop, knock them out. And the shakeout demand tail is on low relative volume. So what is this telling you about institutional distribution and supply? Is there a lot of it in this region? No. It's just shaking out the last of the breakout traders, just retail traders being knocked out of positions as normal. Okay, see this? The volume. Not even above the 30-bar average being the black line. So it's awareness of, okay, there's retail traders buying there. Great, the institutions, knock them all out there. So then, what I'm then doing here, this is why I then add here, because I'm like, again, the line in the sand. Okay, the line in the sand. My expectation is great. We see the retail traders trying to buy here. Great, the institutions knock them out there. So now there's a shakeout demand tail onto the 10-day, and Uber is now building a cup and handle. Great, I can be looking to add there. So now I can add to my position, stop loss just underneath the low of that bar. Now again, what I look for with it, whether it be an add, whether it be a new position, is my stop loss is at least underneath the 10-day EMA. That's what I really like to look for. It just helps me not buy extended stocks, right? So then I'm not kind of chasing a stock up here and then my stop loss is then underneath. Say if I'm like buying it here and my stop loss is here, what did I tell you about having like a 5% stop? So I'm buying it up here, my stop's 5.5, but like no. Okay, I'm going to wait for the stock to pull in at least to the 10-day. But quite often my setups and my entries are around 10-day, 21-day when you get a clustering, potentially the 50-day there as well. It depends on the context of the market. But this is about awareness. Okay, retail traders in there, great. Large operators, shake them out there, line in the sand. I'm going to add through the high of that shakeout demand tail. For me, optimal entry candlestick, stop loss just underneath the low. Initial stop is 3.25%. That's going to be about 1.5 times. If we say the ADR at this time as well is 2.65, about 1.5 times. Okay, it's in the metric. It's not above 4-5%. Okay, good. So then what I can do as well is you'll see that the initial risk on that is going to be $2.07. Okay, so this is what that minus 207 means. So yes, it's a 3.25% stop, assuming that I get stopped out at 61.67. Usually you get a bit of slippage, but the initial risk on those ad shares is going to be $2.07. But look, I've got this entry down here where I bought them at 59.19. So what I can do is I can just move that up. So watch this go to around 207. Okay, so as this goes to around, say, 207, so this 2.08, I can't be asked to fluff around with it, okay? But this here, what it means is I can just raise my stop loss on my initial shares like this. So then if I get knocked out on the ad shares and I then get knocked out here as well, guess what? It's going to be break even. So I'm doubling my position size, and actually I could really push into it and be aggressive here because of how I feel about Uber as well. Okay, I can really kind of power in here, but I'm taking no additional risk because I'm backstopping in the profit. So assuming that the half that I have here, okay, if I was to add that back, so I'm then doubling my position size, but I'm backstopping in a profit the same as the risk there, I'm effectively risk-free. I've doubled my position size with no additional risk. So that's the benefit of having awareness of, okay, what type of base. So I really like it is when you see these pullbacks to, say, key moving averages like 50-day or 21 days, and then I'm thinking, oh, a cup and handle could form. Great, I can target an entry down here, lower in the base, and then I can target something in the handle, like this schematic over here. Target something lower in the base and target something in the handle. Potentially then I can then be adjusting my initial stop loss up like this, backstop in the profit like Uber, and I can really load the proverbial boat and then see if a decent trend wants to unfold. So for me, what I'm then looking to do is try and ride 10-day EMAs, 21-day EMAs, potentially keep some back for the 50-day as well. If price gets extended from the 10-day EMA, I'll think about choking off all or part of the position by going lower the bar, lower the bar, lower the bar. But then what I'm trying to do is get positioned and ride this. Then an exit's there and an exit's there. Had I been in a trade from down here, but I wasn't. There was a lot stronger stocks than Uber here. But then I'm just trying to ride these intermediate term trends. So to do that, I use combination of 10-day and 21-day. If I want to keep some back for, say, the longer term trend, then I'll be thinking about using the 50-day moving average. So I wrapped the video up there, guys. Hopefully it was insightful for you in terms of really just breaking down a chart and really thinking about, okay, what are you seeing and where are you seeing it, utilizing multiple time frames, thinking about entries around continuation basis. So thank you very much for watching. I look forward to seeing you in a future video.